Hello everyone. Today we will talk about hedging strategies using futures. Okay. Uh, so ideally, any investor would want something called as perfect hedge. What is a perfect hedge? Perfect hedge is a transaction that eliminates the risk completely. Okay. Transaction that eliminates the risk completely. However, it is not possible to have a perfect hedge for a variety of reasons, and one of the reasons is the time at which you would need to buy or sell a commodity is uncertain. So this is more true in case of commodity based portfolios than the shares. So individual investors like us who are investing in shares, for us, okay, buying and selling at any time is fine. But the companies who are involved in different commodities, for example, you have a company and for which you need you need to pay some foreign currency to one of your other partner companies in the long run, then you are going to need to pay that amount at some future time point, and at that time point whatever is the rate of that foreign currency you will have to pay. Okay, and you can decide that okay, now currently the rate is favorable, so let me pay in advance. That can't happen. Similarly, the big industries, for example, you have a steel industry and you want raw iron, so you are going to need iron at some future time point. Right now you may not be able to predict exactly at what time point you need to buy it, and you can't buy it now and store because that would be costing you a lot. Okay, so in such cases, the time at which you would need to buy or sell the commodity is uncertain. You would need to buy or sell the commodity is uncertain. So this is one reason. And second reason is sometimes you may not get, say, futures or options on exactly the same commodity. Okay, so futures or options for all commodities need not be available. So you might be interested in something and futures may not be available for that. So you may have to look into futures on similar commodities. Okay, on all commodities need not be available. For example, airlines need their fuel, right? Airlines need their jet fuel. But then futures on jet fuel may not be available, whereas futures on other types of oils may be used for compensating for losses from, say, jet fuel transactions, which are spot transactions. Okay, so you may need to invest in futures on similar commodities. So when I say similar commodities, the price movements won't be perfectly in sync. Price movements would be more or less in the similar direction, but they won't be perfectly in sync. As a result, you can't eliminate the risk completely. Some gap would always remain. So these are the reasons why perfect hedge doesn't exist in practice. Still, of course, people would try to minimize the risk as far as possible. So there are two types of hedging strategies. One is hedge and forget. So first strategy is hedge and forget, and second is dynamic hedging. So what do we mean by these two strategies? As the names indicate, hedge and forget is you initially set up some hedge and you don't do anything else. Okay, initially set up some hedge and then you look into it only at that time when you actually need to do some transaction, either buying or selling or closing out. Okay, I'll explain what closing out is. And dynamic hedging is continuously monitoring the market situation and making adjustment. Continuously monitoring the market situation and making adjustments. Okay, so these are two types of strategies. Of course, when you say continuously, you would still have some gaps in the transactions, because otherwise transaction costs would shoot. So let us see an example how futures can be used for hedging. Okay, suppose investor gains rupees 10,000 for each rupee 1 increase in the prices of certain commodity, in the price of certain commodity, and he will lose rupees 10,000 for each rupee 1 decrease in the prices. Of the same commodity. Then, in such a situation, what would be the hedging strategy? Hedging strategy would be to compensate losses from one with the profits from other. Okay, so what would be the hedging strategy? Take short position in futures. Take short position in futures. Short position means you are going to sell something. Because of that, what happens? In futures, so you have some strike price, say K. You have taken short position means you are going to receive K. Okay. So what will be payoff from the future? Payoff from the future is K minus ST. Right? You are going to receive K when the market price is ST. So if market price increases, then what happens? If market price increases by 1 rupee, then your payoff decreases by 1 rupee. Correct? Then payoff decreases by 1 rupee. Am I right? Because now it is K minus ST. So if market price increases, so ST becomes ST plus 1, then your payoff becomes K minus ST minus 1. And if market price decreases by rupee 1, then your payoff increases by rupee 1. Correct? So this is exactly opposite to what was the situation here. Here, for each rupee 1 increase in the market price, the investor was gaining 10,000. So now you create a reverse position. So you take a short position in futures. So whatever happens here, that would be compensated by whatever is happening here. So no profit, no loss. And remember, hedger is okay with no profit, no loss situation. Hedger doesn't want profits. Speculators want profits. Okay. Or arbitrageurs want profits without risk. Hedger is okay with no profit, no loss situation and basically is more interested in no loss. Okay. So in futures, you take opposite position in such a way that things get compensated. So if you are taking short position in futures, it is known as short hedge. If you are taking long position in futures, it is known as long hedge. And as I said, the hedge is never perfect because the timing of the actual transaction may be unknown even to the investor. Okay. there is another concept called as closing out a position. So what is meant by closing out a position? Closing out a position means entering into a reverse contract. Okay, so what do I mean by that? Let me take a small example. So this is my timeline 0 to capital T. Okay, let us say you are owner of a steel industry and you know that somewhere between 0 to T you are going to need to buy iron. Okay, so you have to buy iron. Today's prices may be acceptable to you, but you can't buy iron today because you don't have storage space. So you know that whenever your current storage current stock is exhausted, at that time point somewhere here you need to buy. So you enter into a long position in futures contract with expiry time capital T. Correct? Because why capital T? Because the in between what happens, I don't know. Okay, we don't know at exactly what point in between we are going to need. So this 0, let me call as say time 1, and this is capital T, and at some in between time point you may need the supply. Okay, so you enter into a long position in futures contract with expiry T and you have some strike price for futures. So let me call it F1. And this entering into a long position has happened at time T1. Okay, so at T1 you enter into a long futures contract with expiry T and by the agreed price is F1. Now what does it mean? It means that at time point T you can buy the commodity by paying rupees F1. But then your need arises at this time point. Okay, so what would we do? Of course, you will have to buy from the market at that time point and you don't know this time point in advance. Suddenly now you come to know that okay, I need iron now. So you will need to buy from the market at T2 because your need arises and this is unpredictable thing. So you have to buy from the market at T2 at whatever rate is prevailing. So suppose at T1 the rate is S1, at T2 the rate is S2 and ST would be rate here. So you buy from market at T2 by paying rate S2. Now you may feel that okay, why did I take long position in futures then? Anyway I have to buy whenever I have to buy. This long position in futures is for hedging. In what way? So I still have that long position in futures. This market transaction has happened irrespective of my futures position. Now I need to do something with my futures position because whatever money I had for buying that iron, I have already used it at this time point. In fact, I might have used extra or less. So at capital T, now I don't have enough money to honor my futures contract. Secondly, I don't even need the iron now. So if at capital T I get the iron, then I don't know what to do with it. So as soon as you buy from market, you close out your initial position. Close out your initial position means what? You enter into a reverse trade. So by entering into a short position again in a futures contract with the same amount means same quantity, entering into a short position in futures contract with maturity capital T again. Okay, with maturity capital T, and for this futures contract the price may be F2. Okay, so you take now a short position opposite of what was your earlier position. Okay, so you had some money, you bought iron, so your iron requirement is finished. and whatever money you had, that is also kind of finished. And now at capital T, what happens? At capital T, you have to do transactions for two opposite positions, so they will kind of pay for one another. So from your short position in this second futures contract, you have to sell, and from earlier long position you have to buy. So you buy from first contract at F1 and sell via second contract at F2. So the iron is gone, you bought and you sold it, so no question of iron, and money also more or less gets compensated. So whatever you get from the second contract, you spend the same thing in the first contract. So you don't need money from your own pocket except for the differences. But why this is to be done? This might seem like an unnecessary exercise, but this is going to compensate for at least part of your losses. Because when you buy arbitrarily at the spot price at some intermediate time point, you may face a huge loss. So some of that loss can be compensated via these opposite transactions at the end of the time period. Okay, is it okay? So let me now deal with the same example but in slightly more detail. So now we'll introduce the notations and we'll try to formalize the argument, assuming the concept is clear. Is it okay what we are doing? So closing out means we are taking opposite position. Okay, so we are entering into the reverse trade. Now as I said, we need to introduce some notations. So there is something called as basis risk. So what is a basis risk? Basis risk is spot price of the asset to be hedged okay. Basis risk is spot price of the asset to be hedged minus futures price of the contract used for hedging. Futures price of the contract used for hedging. Okay, this is basis risk, and let us compute basis risk at different time points in this example. So I have timeline 0 to capital T. 0 we are going to call as say T1, then we have somewhere here T2. Okay, so basis risk at time point 1, B1 would be S1 minus F1, okay, and B2 would be S2 minus F2 because these were our notations. So S1, S2 are spot prices here and F1, F2 are futures prices here. Of course, F1 is for futures of duration 0 to capital T and F2 is for futures with duration T2 to capital T. Okay, so for the second futures, the total duration is smaller. Expiry time for both the futures is the same. Okay, so we have seen what is short hedge and long hedge. So what happens in short hedge? What would be the payoffs? Let us see. So when would a person enter in a short hedge? When he or she knows that they have to sell the asset at a certain time point in future. Okay, so remember the direction of the hedge is same as the direction of the initial hedge is same as the direction of the contract that is expected. Okay, so if you are expected to buy something in future, then you enter into a long hedge. If you are expected to sell something in future, you enter into a short hedge. Okay, so short hedge is when hedger knows, suppose that a hedger knows that they have to sell the asset at some point in future they have to sell the asset at some point in future. Okay. Then they enter into a short hedge. So what is the payoff? What is the total payoff? See, again let me worry about the timeline. 0 T, 0 is actually T1, somewhere here T2. Okay, so we won't worry about the interest rate right now. We will ignore the interest component. It's going to be minor because capital T is also going to be at most like 3 months or something. So at T2, suddenly the need arises and the person has to sell. So the person has to sell at whatever the prevailing market rates are. So at S2, so the payoff received will be S2 from this transaction at T2, spot transaction, and at T1 there are two things. So initially the person entered into a short position in hedge with F1 as the price, and at this time point the person has to close out the position by entering into long hedge with this price. So at capital T, for the earlier short hedge means for selling, so by selling the person will get F1, and because of this long hedge the person has to buy at F2. Okay, so this will be F1 minus F2. Okay, so what is this? S2 minus F2 plus F1. Okay, so this is F1 plus B2. So the payoff is F1 plus B2, basis risk at time point 2. Okay, for a person in long hedge, what would be the things? Things would be exactly opposite. Long hedge means at 0 the person has agreed that okay, at time T he or she will buy the asset by paying F1, but somewhere in between they have to buy by paying S2, and then they enter into a reverse trade for F2. Okay, so they buy at S2, so money spent, or we can write say payoff. Okay, so payoff here is at time T2 they buy by paying S2, so minus S2 because the money has gone from their pocket, and then at capital T they have to buy from this and sell with this. So sell with this means plus F2 and minus F1. So this becomes minus F1 minus S2 minus F2 again. So the payoff is minus of F1 plus B2. Okay, opposite payoff. Is it okay? So what does it mean? It means that a person in a long hedge and short hedge would have opposite payoffs. That is expected. What does it mean in terms of basis risk? So if basis improves, means if B2 increases, then for a person in short hedge it's a good thing because the payoff is B2 plus something. So for a person in short hedge it's a improvement in position, whereas for a person in long hedge it's a bad thing. Okay, so this would mean worsening of situation if B2 is high. Similarly, if B2 decreases, person in short hedge sees worsening in the position and person in long hedge sees improvement in position. Is it okay? So let us now take one small example of this type of hedging and closing out the position. Okay. So let us say today's date is second May, right? Today's date is 2nd May, and a US company expects to receive 50 million Japanese yen at the end of September. Okay, US company expects to receive 50 million Japanese yen at the end of September. Now the problem is, this is expected, so it is not 100% certain that the payment would come at the end of September. Okay, so they have to keep some margin, and they will receive this yen, means to get the real money they will have to sell yen to get dollars. So their aim or need is to sell the asset. Future currency is asset, right? So they'll have to sell those yen. Once they receive the yen, they'll sell those yen in the market and get dollars. Dollars is real money for them. Okay, so their aim is to sell the asset, so they should enter into a short hedge. We saw that the hedging direction has to be similar to what you actually need to do. So they have to enter into a short hedge. Okay, so they are expecting to receive this in September, but as I said, there are two things. First is, there is going to be some uncertainty, so they may, instead of September, they might receive it in say first week of October, etc. And secondly, the futures contract may not be available for maturity at that date, means for example say in first week of October. Okay, so suppose they have future contracts which are maturing in December, but they don't have any future contracts which are maturing in say October and November. So they have futures maturing in, let's say, month of June, September. So in the market only March, June, September and December maturity futures are available. So March is of course gone, June is gone because the payment is not going to be there till September, and now in September also they can't have because they are expecting by the end of September, so it may go slightly beyond that. So they will have to invest in December futures. Okay, so they take short position in December futures, and for December futures the price is 0.78 cents per yen. Okay, is it okay? The price is suppose 0.78 per yen for December futures, and for September futures the price is suppose 0.725 cents per yen. Okay, September futures are also going to mature in December. Okay, and the spot price in September, on 30th September, is suppose 0.72 cents per yen. So these are the things we need, right? S2, F1, F2. So what is the transaction that they are going to do exactly? Let me revise. So this is 0, this is capital T. So this is December and this is a 30th September. So let us say that they actually received the money in the last week of September, the yens in last week of September. Now they are not going to wait till December to encash those yens. So what they do is they close out a position here. So they sell the yen in market at this rate, the market rate. But of course they already have a short position in future. So to compensate for that, they enter into a long position in second futures contract at this rate, because now in September the future rate is this. Is it okay? So they sell in the market means they receive 0.72 cents per yen on 30th September. In December they will have to sell the yens at 0.78, so they'll be receiving 0.78, but they enter into a long position here, so they'll have to buy yens at 0.725. Okay, so this is exactly what we derived earlier, S2 plus F1 minus F2. Okay, and this turns out to be I think 0.775 per yen Okay, so this is like the effective rate that they got. Okay, and you can see here that this rate is higher than what they got in the market. Okay, so I was telling you why people want to do these kinds of business, means enter into a contract, then enter into a reverse contract. Why not just ignore the futures and sell whenever you receive? So if they had sold just when they received without bothering about entering into a futures, they would have to sell at 0.72 only. So they'll get only 0.72 cents per yen. Okay, whereas now because they had done these future hedging via futures, the effective rate that they got is 0.775 per yen, which is large. Okay, so it is higher. So this is the benefit of hedging, that even though the prices dropped, so initially the price was 0 0.7, initial price we didn't write, but it would be of course somewhere near 0.78 because S and F are generally closer to each other. So the initial price was high, the prices dropped, but because the company had already entered into a futures contract, it didn't suffer that much from the price drop. Okay, it got a decent rate. 0.775 is a decent rate. It got the rate almost near to its initial futures price. Is it okay? So this is the benefit of hedging. I mean, this is the benefit of futures, and that's why this is hedging using futures. Is it okay? So why we are entering into so many transactions unnecessarily? It's not unnecessarily. It is to compensate for your losses. Okay. So let me stop here. Thank you.